Hello, I'm Mark Homer and we are in the old M&S building, 99 apartments. We're in phase 1 and 2, which are largely complete. And we're in one of the kitchens right now, which is nearly ready. In this video, I'm going to give you an update on where the economy is right now and what we're going to be looking at for the next 6 to 12 months. Before we get started with this video, make sure you like and subscribe. So the property market is clearly still booming, especially for houses in more leafy areas. I've just had a friend on today, just show me a house in a village not far from here, sold, I think it's about 3,500 square foot, nice 5-bed house, sold for 1.35 million, cash, full asking price, sold within a week. And I think that's £380 a foot. For a village around here, for a sort of 10-year-old property, that's really strong money, really strong money. And that's probably a level I've never seen before. I'm certainly seeing it here with our little terraces. They've been increasing significantly. I think there's a lot of people chasing not enough properties. I think flats have lagged behind, but apparently they're catching up now, and I think you'll get a double bubble on flats because shortly leaseholders are going to be able to extend their leases to 999 years with no ground rent, so you'll probably see the value of flats increase significantly once that actually happens, because it's quite clear they're going to be put in the position almost as if they were a freeholder shortly. I mean, the bubble, the growth that we're in at the moment is clearly significant. Is there going to be a crash? It's the crash that never happened. Who knows? It could happen. It depends when there's a shock, doesn't it? Last time the shock was the banks got themselves into trouble and stopped lending. Well, that'll definitely do it. This time we had a pandemic, but the government supported it all with lots of cash. I suspect if this time you'd had George Osborne and David Cameron in charge, the result might have been different. Maybe they wouldn't have supported the economy to the same extent, and the government wouldn't have taken quite so much debt on. But Boris, ever the people pleaser, has tried to retain his popularity. Looks like he's doing that reasonably successfully, and let's just say perhaps he's leaving somebody else to clear the mess up in future years. So furlough's supposed to end in September. Clearly that's the biggest test. I've heard so many times that things are all going to go wrong when the furlough ends, and they've extended it. Clearly, if everything's open by September, the argument for extending it will be very weak. So you would imagine that there's a high possibility it will end. Clearly, the government is trying to match the demand for labour with the point at which they remove the furlough scheme. So it remains to be seen what effect that will have. It's definitely going to have some effect, because furlough has become the waiting room to redundancy. Clearly, when the stamp duty holiday ends, June, that is going to have an effect as well. I suspect it will slow down the residential property market. That could be significant. Is it going to on its own create a crash? I think it's pretty unlikely. We saw in 2016 big stamp duty changes. This doesn't have to be like MIRAS, when the mortgage interest relief ended decades ago, and that some people say precipitated the crash then. But clearly there are loads and loads of things happening, loads of moving parts, and especially at the moment as we come out of a pandemic, we're unsure where things are going. So it could change move on a sixpence. I get asked a lot from investors, should I buy now or should I wait? What you should do is go and find a really good deal. And if you can find a really good deal now and you get good income from it and it yields well and you hold on to it, it will be a great thing. Yes, timing is important, but it can be quite difficult to work out exactly where you are in the cycle. Property prices over the next 10 years, are they going to go up? Very likely. But in the short term, it's very difficult to know what the direction is. If I was offered a really good deal and I could convert it, or maybe it was a single let and I was getting it for a really good price, and I could refurb and add lots of value and it was a good yield, yes, I would buy now. So clearly we've had a really disruptive year. What I certainly and many other people couldn't predict was the extent to which the government and Boris and Rishi would get their checkbook out, spray money all over the place, a little bit like what Boris seems to do in his private life. The result of that is there's a huge amount of debt gone onto the government's balance sheet. They need to sort of pay that back. What that's done, it's really helped the real economy, and most economists are now predicting a post-pandemic boom like we haven't seen since perhaps the Second World War. Everybody's been inside, the savings rate has gone absolutely stratospheric, people have not been spending their money, and apparently now, as we open up, people are going to be spraying that money all over the place and spending. So that's going to create GDP growth, it's going to create economic growth. House prices, you've seen what's happening to those. A lot of that is because people are wanting to move, but in addition, the lenders have just kept on pumping the money out. The Bank of England has encouraged them to do it. Stamp duty is still relatively low, and people have been looking for more space. So what happens for the next sort of 6 to 12 months? Well, I think it's pretty clear that the government is going to have to let inflation rise. And that's going to be probably one of the main ways that they're going to pay this debt back. So they're actually going to devalue sterling by inflating it, and the same is going to happen to the US dollar, and the same will happen to the euro. So it'll happen at a similar rate between them, so the exchange rate might not change that much. The pound in your pocket is going to be worth less. That is a key way to pay debt down. If you've got, let's say the government's got £2 trillion worth of debt, if you can increase inflation and also GDP, make the economy bigger and also increase prices by devaluing the currency, you can effectively increase the amount of tax take that you receive from individuals, from companies, from different parts of the economy, and then you can use that to pay your debt down. So the real value of that 2 trillion is going down even if the government is not paying any of it back physically. The same happens with your mortgage. As inflation picks up, inflation will pay the mortgage down, and even in interest-only mortgage, because what it will effectively do is increase your wages, and all of the money that you can take from your customers and everywhere else will increase, therefore meaning that you can pay your mortgage down quicker. So that's clearly the strategy. It happened after 2008, 2009. We saw coming out of that last recession, the government used a lot of QE, quantitative easing, they increased the money supply and they let inflation run higher. It wasn't massively high, it didn't get anywhere near 5%. And I don't think we're talking about double-digit inflation or anything like that, but it's going to go above the 2% target, I think, or they're going to sort of let it run there. They've also moved from the RPI to the CPI. The RPI was the Retail Prices Index, that registered a higher number. The CPI is quite a bit less. It registers maybe about 1% less, something like that. So some would say that's another way in which they're making inflation look less than it really is. So we're seeing a lot of inflation in the cost of materials, in the cost of labour. We're seeing electronics that we needed to import. Even sort of there is some wage inflation just because the furlough scheme is continued. I know in some sectors, certainly hospitality, they're having problems rehiring because a lot of those staff have gone abroad or they've gone into other industries. So there will be wage inflation there as well. You wouldn't have imagined this scenario just a year ago. We were all talking about deflation and sort of hugely negative GDP, economy contracting as the government shut it down. But looks like on the 17th of May, the next step will be taken, the economy will open, and then more and more will be spent as people do more and more in the economy and go out more and more. Post 2008-9, there were various commentators and lots of members of the public thought we were going to have hyperinflation. Let's say inflation rates of above 10%, going back to the 1970s. It didn't happen. The Bank of England managed to control and just sort of set interest rates and QE and the other levers they've got to match the amount of money with demand reasonably successfully. But what happened was asset prices increased significantly as interest rates went down. That's likely to happen again now. You've seen with house prices, asset values are going up. Part of it's low interest rates and easy money and QE and the money supply increasing. So the Bank of England clearly doesn't see hyperinflation. I don't think most of the market sees that either, but certainly higher than 2%, maybe less than 5%. But these things can be very, very difficult to predict. And clearly there are so many little wheels that move, so many different things at the government, the Bank of England, and things that can go on in the economy, commodity prices, oil prices. All of this stuff feeds in to create an unpredictable result to some extent. So clearly the S&P, the FTSE, Dow Jones, Hang Seng, all those markets around the world, the equities markets, the stock markets have been doing very well coming out of the pandemic. And there's definitely been a shift from tech stocks to value stocks. So, you'll see the sort of old school, Unilever or, maybe the utilities companies, all of those, or maybe even tobacco, where they have sort of strengthened, at the expense of, say, the Amazon, the Apple, and maybe the Google. They did very well through the pandemic. They're still not doing, badly in terms of share price, but the emphasis has switched to value because now, as we come out of the pandemic, it's the old school sort of staples that are likely to start doing better again, and their profits are likely to increase. Clearly, if the market can see inflation coming, that means the prices those companies will be charging will be greater, therefore profits will be greater, and therefore share price goes up in advance of that, in anticipation. So that some of that is baked in because of all the quantitative easing that they're doing and the support that they've given. But all those markets are doing very, very well. Is there going to be a crash? Well, you can never predict in the short term when the crash is going to be. There definitely will be a crash, but it could be many years into the future. I think if you're investing in those markets, you're pound cost averaging, you're going in at various different points and you're investing over the long run. I'll probably go into trackers mainly. You can get your 6-7% capital and income all rolled up over the long run. So I tried to have a go at Rolls-Royce first thing this morning, and I put a fill or kill order in, and I didn't quite get it for the amount that I wanted. The aviation sector has clearly taken a beating. It's going to be one of, if not the last sector out of this pandemic recession. Rolls-Royce supplies the engines to all the airlines. Would that be a company that's likely to be here in sort of 10, 20 years time? Yes, quite likely. Do I believe in the business model? Yes, absolutely. Are they having an issue at the moment because they got massive losses because they can't supply, the airlines don't want to buy the engines from them? Yes. So to me, this is like another VW or like BP when they were spilling oil into the Gulf of Mexico. There's been loads and loads of these which I quite like. Co-op, we had to go on that when they had their bother. Had to go on Lloyd's in the middle of the pandemic. That's been quite nice. Is Rolls-Royce going to go down more? Quite potentially, quite possibly. But is it going to look like a good thing, in 5 or 10 years' time? I think there's a good likelihood of that. People are constantly asking me, will the market crash or will there just be a correction? That could be the same thing to a lot of people. I have absolutely no idea. In the short term, I just think it's a naive question. Nobody has the answer. Therefore, asking someone the question and expecting them to give you an accurate answer is a fool's game. If you've enjoyed this video, please like and subscribe. That's my update, my predictions of the market. Thank you very much. It's Mark Homer, over and out.